Every major financial crash in modern history followed the exact same pattern. 1987, 2000, 2008. Three completely different crises, three different decades, three different causes. Or so everyone thought. But here's what most people miss. They all started the same way. The same signals, the same psychology, the same slow-motion unraveling that in hindsight was completely obvious. The scary part? Those same signals are appearing again right now. I've been watching markets for a long time, long enough to see multiple cycles come and go, long enough to watch people lose everything while the warning signs were sitting right in front of them. And every single time I hear the same words afterward. Nobody could have seen that coming. But that's not true. People did see it coming. A few of them, the ones who knew what to look for. And today, I want to show you exactly what they were looking at. Because history doesn't repeat, but it rhymes. And right now, it's starting to sound very familiar. Let me take you back to the beginning. Not 2008, not 2000, further back. Because to understand the pattern, you have to see where it starts. And it almost always starts in the same place. It starts with cheap money. In the early 1970s, something happened that permanently changed the global financial system. The United States abandoned the gold standard. For decades, every dollar in circulation was theoretically backed by a physical reserve of gold. But in 1971, President Nixon ended that system entirely. From that moment forward, the dollar, and by extension the entire global economy, was backed by nothing more than confidence. Now, you might be thinking, what does that have to do with crashes? Everything. Because once you remove the hard constraint on how much money can exist, central banks gain an extraordinary power, the power to create money at will. And here's what always happens when you give anyone extraordinary power with no real limit. They use it, especially when things get uncomfortable. Fast forward to the late 1970s, inflation in the United States had been climbing for years. By 1979, it hit 13.3%. Think about that. Everything you owned, groceries, gas, your mortgage, was getting 13% more expensive every single year. The dollar was losing its value faster than people could save it. Workers were demanding higher wages. Businesses were raising prices to compensate. It was a spiral, and it was accelerating. Now here's where things get interesting. The Federal Reserve, under new chairman Paul Volcker, decided to do something almost unthinkable. Instead of lowering interest rates to stimulate the economy, which is the easy, politically comfortable move, they raised them dramatically. By 1981, the federal funds rate had climbed to 20%. 20%! Today, a 5% interest rate causes market panic. Imagine 20! The medicine worked. Inflation broke. But the cure was brutal. The U.S. entered a severe recession. Unemployment climbed to nearly 11%. Businesses that had borrowed money at lower rates suddenly couldn't survive the new cost of debt. The housing market froze, and across the country, people who had made financial decisions based on the assumption that the old conditions would continue were suddenly devastatingly wrong. That's pattern number one, and write this down because you're going to see it again and again. Conditions change, suddenly and violently, and anyone who built their financial life on the assumption that conditions would remain stable gets wiped out. But here's what most people miss about that period. The pain of the early 1980s set the stage for something that looked on the surface like a miracle. Once inflation broke and interest rates started coming down from those extreme levels, a powerful economic expansion began. The stock market started climbing, business investment picked up, and throughout the mid-1980s, a feeling of optimism, almost euphoria, began spreading through Wall Street. By 1987, the Dow Jones Industrial Average had more than tripled in 5 years. Tripled! Investors who had been cautious started feeling foolish. People who had stayed out of the market watched their neighbors getting rich and started wondering why they were sitting on the sidelines. Money started flowing in from everywhere. New financial instruments, portfolio insurance, index futures were being used in ways nobody fully understood yet. And then, on October 19, 1987, the market fell 22.6% in a single day. One day, the largest single-day percentage drop in stock market history. $500 billion erased in hours. People who were millionaires on Friday were trying to figure out how to pay their mortgage on Monday. What happened? The official explanations point to program trading, overvaluation, rising interest rates, and all of that is true. But here's what the explanation always leaves out. The crash didn't cause the vulnerability. The years of unchecked optimism did. The belief that because the market had gone up for 5 years, it would continue to go up. The quiet dismissal of risk, the gradual, almost imperceptible shift from investing to speculating. That's pattern number 2. And this one is subtle, so pay attention. There's a moment in every bull market where investing becomes speculation, where people stop asking, is this a good value, and start asking, how much more can I make? That shift happens slowly, then all at once, and by the time most people recognize it, it's already too late. Now let's jump forward to the late 1990s, because what happened in the dot-com bubble is one of the most instructive episodes in financial history. Not because of the crash itself, but because of how obviously, almost comically clear the warning signs were, and how completely people ignored them. Something happened in 1994 that most people don't think about when they discuss the dot-com bubble. The Federal Reserve, concerned about an overheating economy, raised interest rates several times throughout the year. Short-term rates went from 3% to 5.5% in 12 months. Markets stumbled. There was pain. And then, and this is crucial, the Fed started to back off. By the mid-1990s, rates were coming back down. Credit was flowing. Capital was available. And right at that moment, the Internet arrived. I don't mean that the Internet was invented then. I mean that suddenly, for the first time, ordinary people and major investors could look at this technology and say, this is going to change everything. And they were right. The Internet did change everything. But being right about the technology and being right about the valuation are two completely different things. By 1999, companies with no revenue, no profit, sometimes no actual product, were being valued at billions of dollars. Pets.com raised $82.5 million in an IPO. It had a sock puppet mascot and a business model that lost money on every single transaction. It went bankrupt 9 months after going public. Webvan, an online grocery company, raised over $375 million and went bankrupt within 2 years. Cosmo.com promised 1-hour delivery of anything, anywhere, and burned through $280 million before folding. Now, you might be thinking, those were obviously bad companies. How did investors not see that? And here's where the psychology becomes terrifying. Because for most of the late 1990s, it didn't matter. The stock prices kept going up. Every week there was a new IPO. Every month, someone who had bought shares in some obscure tech company became a millionaire. The NASDAQ, the index that housed most of the technology stocks, went from around 1,000 in 1995 to over 5,000 by March of 2000, 5 times in 5 years. And somewhere in that climb, a very dangerous idea took hold. The idea that the old rules no longer applied, that this new time was different. The traditional measures of value, earnings, revenue, profit margins were relics of an older, less dynamic economy. That in the new world of the Internet, you had to think differently. You've heard those words before. This time is different. Those are the 4 most expensive words in the English language. Every single bubble in history has produced them. Every single one. By the time the NASDAQ peaked in March of 2000, price-to-earnings ratios on major technology stocks were at levels that made serious analysts physically uncomfortable. The average P/E ratio for S&P 500 companies hit 32 in 2000, more than twice the historical average. Some tech companies had P/E ratios in the hundreds. Some had no earnings at all, and nobody seemed to care. Then the Fed raised interest rates again. Between 1999 and 2000, the federal funds rate went from 6.5% to 6.5%, and the music stopped. The NASDAQ fell 78% from peak to trough. 78%. $5 trillion in market value gone. Not transferred, destroyed. Investors who were paper millionaires in March of 2000 were back to where they started, or worse, by 2002, and the economy tipped into recession.
Companies laid off workers by the hundreds of thousands. The unemployment rate climbs from 4% to nearly 6% in less than 2 years. But here's something most people don't know about that period, something that would have enormous consequences later. In response to the dot-com crash and a struggling economy, the Federal Reserve cut interest rates aggressively. From 6.5% in January 2001, they cut all the way down to 1% by June 2003. 1%, the lowest rates had been in over 45 years. Cheap money, again. And that's when the real problem started. At 1% interest rates, banks could borrow money for almost nothing, and they needed somewhere to put it, somewhere that seemed safe, somewhere with a long track record of stability. And they found it: housing.
Now, this is where things get interesting, because the 2008 financial crisis is often described as a mortgage crisis, or a banking crisis, or a crisis of greed, and it was all of those things. But at its root, it was the same pattern we've seen before: cheap money, speculative investment, the gradual abandonment of risk awareness, and an entire industry's collective decision to believe that the good times would last forever. Between 2000 and 2006, U.S. home prices rose by roughly 90% nationally, 90% in 6 years. In some markets, Miami, Las Vegas, Phoenix, prices doubled and then doubled again. People who had been renters became homeowners. People who owned one home bought investment properties. Investors who had been burned by dot-com stocks saw real estate as the safe alternative. But something strange was happening beneath the surface. The lending standards that had governed mortgage markets for decades were quietly disappearing. Banks began offering adjustable-rate mortgages that started with absurdly low payments and reset, often dramatically after 2 or 3 years. They began offering no-documentation loans, where borrowers could state their own income without proof. They began offering mortgages with zero down payment. Some lenders were offering mortgages that actually increased in principal over time. And at the time, nobody noticed, or more precisely, some people noticed and they were ignored. Here's what was happening behind the scenes. These mortgages weren't sitting on the bank's balance sheets. They were being bundled together and sold to Wall Street, where financial engineers were packaging them into securities, CDOs, mortgage-backed securities, that were then sold to pension funds, insurance companies, and investors around the world. The risk wasn't being contained. It was being dispersed invisibly across the global financial system. Rating agencies, the companies paid to evaluate the safety of financial products, were giving top-tier ratings to securities that were stuffed with mortgages that should never have been made. And because everyone in the chain was making money, nobody had much incentive to ask hard questions. By 2006, roughly 20% of all new mortgages in the United States were subprime, made to borrowers with poor credit histories, limited income documentation, or both. Total household debt in America had climbed from $7.2 trillion in 2000 to over $14 trillion by 2008. The entire foundation of the expansion was debt, borrowed money, and it was borrowed at rates that were only sustainable as long as interest rates stayed low and home prices kept rising. They didn't. In 2004, the Federal Reserve began raising interest rates again. By mid-2006, the Fed funds rate was back up to 5.25%. Those adjustable-rate mortgages started resetting. Monthly payments that had been $1,200 became $1,800, then $2,200. Borrowers who could barely afford the teaser rate had no chance at the reset rate. Defaults began climbing, then accelerating. Home prices stopped rising in late 2006. By 2007, they were falling. By 2008, they were in free fall. And as home values collapsed, the securities built on top of them, the CDOs, the mortgage-backed securities held by banks around the world, began losing value catastrophically. In September 2008, Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. It was the largest bankruptcy in American history. The global credit system froze. Banks stopped lending to each other because nobody knew who was holding what or how bad the losses really were. The stock market lost 57% of its value from peak to trough. 8.5 million Americans lost their jobs. Home values fell by an average of 30% nationally, wiping out trillions in household wealth. The global economy contracted for the first time since World War II. And afterward, the question that economists and journalists and ordinary people kept asking was, how did nobody see this coming? But people did see it coming. There were economists, analysts, fund managers who looked at the numbers, the debt levels, the lending standards, the home price to income ratios, and said clearly, this cannot continue. They were dismissed. They were called pessimists, doom mongers, people who didn't understand the new financial landscape. This time is different. It never is. Now, let me ask you something. We've walked through 3 crises now. The inflation and interest rate shock of the early 1980s, the dot-com collapse of 2000, and the housing and banking meltdown of 2008. And I want you to think about what they had in common. In each case, there was a period of cheap money, low interest rates and easy credit that encouraged speculation. In each case, that speculation drove asset prices to levels that couldn't be sustained by underlying value. In each case, there were warning signs: rising debt, inflated valuations, loosening standards, euphoric sentiment that most people ignored because ignoring them was profitable in the short term. And in each case, when the cycle broke, the consequences were far worse than almost anyone had predicted. The mechanism changes, the psychology doesn't. So, now I have to ask you something, and I want you to sit with it for a moment. What happened after 2008? The Federal Reserve cut rates to zero. Zero. And then, for the first time in history, began a program called quantitative easing, essentially creating trillions of dollars out of thin air to buy assets and push money into the financial system. Between 2008 and 2014, the Fed's balance sheet grew from under $1 trillion to over $4.5 trillion. Interest rates stayed near zero for 7 years. 7 years of the cheapest money in American history. And exactly what you'd expect happened. Asset prices climbed vertically. The S&P 500 fell 34% in March 2020 and then recovered the entire loss by August, the fastest recovery in stock market history. Home prices in the United States rose by more than 40% between 2020 and 2022. In some markets, homes were selling for 20 or 30% above asking price, sight unseen, with no inspection contingency. Cryptocurrency markets reached a total valuation of nearly $3 trillion in late 2021. Now, you might be thinking, that's all in the past. Things have stabilized. The Fed raised rates, inflation came back down, the worst seems to be over. And maybe you're right. Maybe this time really is different. But here's what most people miss about where we are right now. The debt didn't go away. U.S. total public debt has now surpassed $34 trillion. The federal government is spending more on interest payments than on national defense. Corporate debt remains near historical highs. Consumer credit card debt hit a record $1.11 trillion in 2024. Auto loan delinquencies are climbing. Commercial real estate, office buildings, shopping centers, regional malls is facing a crisis as work from home permanently altered demand, with vacancy rates in some cities exceeding 25%. The interest rate increases of 2022 and 2023, the fastest rate hiking cycle in 40 years, rippled through the economy in ways that are still being felt. Regional banks that had loaded up on long-duration bonds during the low-rate era found themselves sitting on massive unrealized losses. In March 2023, Silicon Valley Bank collapsed in 48 hours, the second largest bank failure in American history. 2 more significant banks followed within weeks. And here's the pattern playing out once again. Years of cheap money encourage borrowing and speculation. Asset prices rise to levels disconnected from underlying value. Then rates rise, and the parts of the system that were built on the assumption of permanent cheap money start to break. It doesn't all break at once, it breaks in pieces. First the weakest pieces, then the next weakest, and so on, until something too large to contain finally gives way. I've watched this cycle enough times to know that the breaks don't happen on a convenient schedule. They don't send a press release. They show up as news stories that seem isolated at first. A regional bank, a hedge fund, an obscure corner of the credit market. And then, one day, what seemed like isolated problems reveals itself as a systemic one. Now, I want to be honest with you. I'm not here to tell you that a crash is imminent.
I don't know when the next crisis will arrive. Nobody does. People who claim to predict the timing with precision are selling you something. What I'm telling you is something different. I'm telling you that the preconditions, the structural vulnerabilities that have preceded every major financial crisis I've studied are present today. The debt levels, the valuation extremes in certain asset classes, the assumption baked into so many financial plans that current conditions will persist, the gradual normalization of risk that always happens in the late stages of a bull cycle. The people who came through 2008 with their wealth intact weren't lucky. They were paying attention. They had studied enough history to recognize the pattern. They weren't necessarily predicting the crash, they were simply recognizing that the risk was higher than most people admitted, and they adjusted accordingly. That's all I'm asking you to do. Pay attention, know your history, understand that economic cycles have always existed, that they always will, and that the warning signs, while they vary in their surface details, follow a remarkably consistent deeper logic. Cheap money creates excess. Excess becomes overconfidence. Overconfidence becomes complacency. Complacency becomes crisis. And then, in the aftermath, the money gets cheap again. And the cycle begins anew. The question you should be asking right now, the question that serious investors are always asking, is not, will there be another crisis? Of course there will. There always is. The question is, when the next one comes, which side of it will you be on?
The people who study these patterns, who understand the playbook, who don't get swept up in the narrative that this time is somehow different, those people don't just survive the crashes, sometimes they define their financial future by them. I'm not saying be afraid. Fear is not a strategy. I'm saying be aware, be thoughtful, understand what you own, why you own it, and what assumptions are baked into its current price. Because the pattern is always there. It's been there in 1929, in 1987, in 2000, in 2008. It will be there the next time, too. The only question is whether you'll recognize it before everyone else does or after. History doesn't repeat, but it rhymes. And right now, if you're listening closely, you can hear the first few notes of a very familiar song.